What's going on, YouTube family? I'm back with another video, and in this video I'm going to talk about how you can make money by targeting liquidity, understanding how the liquidity is being manufactured, and most importantly, how to set up your next trade based on the inefficiencies in the market. Let's get right into it. Okay guys, this is GU on the daily time frame, and the first thing I want to point out is this huge bullish uptrend. We all see this and understand that this is big bullish momentum, correct? Now, what liquidity was taken that actually initiated this move? This liquidity here. You see this low right here and this low right here? They're equal lows, and price ran them. You see this right here, this would be considered a double bottom, and retail would be finding support here and buying up. Now what I see is a target. I see that price wants to make a swing low to a swing high to make lower highs, generate liquidity below these lows, just to run the entire internal liquidity and then the external liquidity here. Okay, and that's why we have these three circles: A, B, C, run. Okay, I know you've heard that pattern before, but it actually works in smart money concepts as well. So what we're going to be focusing on is the price action in this area here, because this is where the liquidity is generated. Let's go to the 4 hour. Okay, we are on the 4 hour time frame, and what I'm going to do is I'm going to pop up some things on the screen. Okay, so what I put in there is all of the liquidity generated in here. Now this is a big consolidation. Okay, what makes this a consolidation? So when price finally reaches it up to this point in the market, okay, this low right here, this is the significant low because it took out the liquidity here. You see all of these wicks, you see all the lows here. This is all the liquidity that was generated in this price action here. Price ran it and then continues to trade higher. Do you see that? Now from this swing low right here to this swing high, we have our dealing range. And when price made a higher low here, from this higher low to this high right here, we created a swing within the larger swing. Okay, don't get confused. This low to this high is the major swing. This swing here to here is going to be the swing that generated the consolidation here. Okay, as you can see, we were trading within this range for this consolidation. Now do notice that we were making lower highs, and this is something that I want you to see. And then finally we make a higher high, fail to beat this high though, and we go downtown. Okay, now we're going to talk about all the liquidity that was generated in here little by little. So we have this high and down to this low. When we come back all the way up here to this swing high right here, we generate equal highs. Price pulls back, runs the equal highs. This is your liquidity resting above your highs. Okay, vice versa here. When we ran up here and pulled the swing low, liquidity was generated and taken here. Okay, so I would actually put liquidity here. Okay, and then we ran it. They ran this when they were pulling up, and then they ran this liquidity coming down. Now price comes up here, fails to make a high, gets rejected at this bearish order block, and then trades lower. This swing here takes internal liquidity out. From this swing here, we pull up here. Now here's the sauce, guys, and I'm going to put this up on the screen. When price takes out liquidity, you're going to see a pullback into an inefficiency. That inefficiency is another type of liquidity. It's called an ICT fair value gap, and that is right here between this wick and that wick. There is a gap in price, an inefficiency in price. And seen as these equal lows were just taken, this is a different type of liquidity. This is manufactured by price action, and you're going to see this happening as markets trade higher or lower. This inefficiency here is a buy side sell side inefficiency, in which price leaves a volume of impulse that push the market down. As you can see, this is a lot of impulse. This is smart money selling down. Okay, we take out this liquidity and we pull back up into this inefficiency. ICT calls a fair value gap. This is going to happen all the time, especially in a consolidating market. Okay, so let's continue to read the price action. So we're now taking it from that swing here. We pull down, pull back up, pull down, pull back up. What do you see forming here? I see equal lows. And what you need to be targeting are the lows. So So price runs those lows. And what did I say happens when price runs liquidity? It pulls back into an inefficiency. Well, here's another inefficiency between this wick and that wick. And then price continues to trade lower, taking out these lows. Now we reach a swing point. This is a higher low. From this swing point here, we make a swing high and reject at the bearish order block. The liquidity is resting above these highs. We make a swing low, we fail to beat the lows, we pull up in here, make another swing low, come up and take that liquidity. Are you seeing the pattern here? Price will continuously do this, and every time it takes liquidity, you'll see a pullback. Why does the market do this? Why do we always see a pullback when liquidity has been taken? Because price moves premium to discount, discount to premium. Whenever liquidity is generated, taken, and then pulls back into an inefficiency, what you are seeing is smart money selling from a premium and buying in a discount. This is how the market flows. Okay, guys, let's keep going. So from this swing high down to this swing low to this swing high, we generate more equal highs between this wick and that wick. We pull down, we run the internal liquidity. Guys, what happens next when price runs liquidity? We expect it to pull back. It pulls back, generates equal highs, okay? Comes, sells down slightly, and then pulls up and runs all the highs. Now, notice how it didn't take out this high here. It made relative equal highs here. But since we are in a downtrending market in the consolidation profile, we understand that these lower highs are to be expected. So what happens once price takes out liquidity? What's the rule we live by? We get a pullback into an inefficiency. So price pulls down all the way down here, takes out all this liquidity, all of it. Takes out all of that liquidity. Comes right back up into the inefficiency. This is the first fair value gap it pulls into. Okay, sells down, makes a swing low. This swing low is significant because it took out the liquidity of all of this so far on the bottom side. So now we're looking at this swing low, and we expect to see a pullback into an inefficiency. So make a swing high, higher low, swing high, we run the high. Swing high, and we generate equal highs here. Okay, we generate equal highs here, and we expect that to get ran. Now, pulls up into there, the major swing points is here, and then sells down and takes out the more internal liquidity. Do you guys see the pattern that's happening here? For every price leg that moves up, the higher lows and the lower highs generate the liquidity, okay? Above and below. So now, when we're down here on this swing point, we expect price to do what? We just took liquidity, fill an inefficiency. Boom. Comes right back into an inefficiency. Pulls back, generates equal lows, comes up, fails to beat the high, and pulls down. And this right here is your bread and butter setup. Okay? Because what's happening right now is that price is just making more and more bearish order blocks. See this bearish order block here? It makes a swing low, swing high right into the bearish order block and inefficiency here. This is an imbalance. And sells down. Now this right here is the major break of structure here, because it took out not only the liquidity, because it took out the liquidity of the entire consolidation, including this swing low to this swing high here. Took out this low here. So now, what do we expect when major liquidity is taken? We expect a pullback. And where does price pull back up to? A bearish order block. Clears all inefficiencies, and then price trades lower. And guess what, guys? You see this right here? If we looked at this at the beginning of our video, this right here just took out the double bottom. So now we arrive here, and if you're trading GU, you've realized that you've been targeting liquidity the entire time, and now what do you expect after major liquidity is taken? You expect for the imbalance to be filled. Okay, so look, price pulls up directly into a fair value gap. Trades down here, And where does it find support on? It's not your retail support level. It finds support off of a bullish order block. And all you had to do is play the consolidation profile here until the market was ready to take out the lows here. Isn't this exactly what we saw up here on a smaller profile? We get a high, just like we had a high here. We get a lower high, just like we got here. And we continue to trade lower until this major swing low forms that takes out this swing that started the consolidation. That's the same thing that happened here, guys. This low to this high, we trade down while holding a consolidation profile. We break structure, take the liquidity, pull up, fail to pick a high, and then we sell down, taking all the liquidity. Well, guess what, guys? The same thing happened here. This swing low here to this swing high is the range. Price continues to trade lower, right? It continues to generate liquidity. Let's zoom in. It creates liquidity here. It runs the liquidity. And after it runs the liquidity, it pulls back into what? What did I say it's going to pull back into? An imbalance, an inefficiency in price. Okay? So price pulls all the way back up into this area right here. Boom. Imbalance right here. Fills it. Fills this completely. Fills all of this. Right? And then makes a swing low here. This right here is not a break of structure. This is still a higher low. It has to close a candle body below this low. So when it pulls up here, it pulls up into an inefficiency. Then it runs the lows. Okay? Now at this point, this is a lower high, lower low, lower high, lower low, lower high, lower low, lower high. Boom, major swing low. This is a major swing low. Why? Because this took out all of the liquidity below. And now when this happened, well, here it is, guys. Here is the first entry to the big bullish trend that we saw all of 2020 and 21. Makes a swing high here, breaks structure, takes out all of these highs. Okay, it comes all the way up here, fills the inefficiency here. Okay, and what happens after we take liquidity, guys? We expect price to pull back into another inefficiency. So it comes down, makes a swing lower, lower low. This actually breaks structure here in one shot. And this again breaks structure again right here. Pulls up, breaks structure, pulls up into this swing, comes down here, makes equal lows. Now, are we looking at these equal lows to be violated? If this from here is the major swing low? No. This right here is optimal trade entry. That's what that is right there. That's OTE. That's OTE right there. You are at the 62 is where I'm taking my entry, but you can take your entry in the deep discount here. I'm waiting for some sort of break of structure right here, and I'm taking the 62 fib entry, and then I'm riding the higher highs and higher lows. And as you can see, the market moves by taking liquidity over and over and over and over again. It will generate liquidity and then run it. Okay guys, that's the video on liquidity. If you learned something from this, if you found yourself smiling, understanding something a little bit more clear, drop a comment down there, man. Let me hear about your experiences learning smart money. Also, don't forget to subscribe and share the video. We're trying to grow. Join our Good Eats Telegram chat, and I'll see you in the next video.